Andrew Holland joins us now, CEO at Avendus Capital, Public Market Alternate Strategies. For more, Andrew, very good morning to you. I'm not sure how good a morning it is for the markets. Let me start on, I think, the biggest question / theory floating around. Funds are moving out of India and going to China, and that's the pain we're seeing. Do you agree with that?
I agree. In some part, it might have happened, Tamana, because obviously, the funds have been, completely underweight China, and if you want to move some money quickly, then you have to find some, somewhere in your fund to fund those purchases in China. So I think, maybe India initially was done that, because what will happen, Tamana, is that as you get money into your emerging market funds, for example, then you'll probably put more weightage towards China. India will get some, whether it's in terms of a neutral weightage or underweight within that new money, but that's still to come. So I think in the short term, we're seeing some money just taken off very quickly. Let me get into China, but I don't think it's like I'm going to go underweight India and overweight China. I still think there's quite a lot of skepticism out there to see that some of the policies which the government's still talking about in China, like fiscal policy, is going to be followed through. So that's what I would say. It's a very short-term move, I think, and I don't think it's going to be long-lasting in terms of flows away from India to China. New incremental money, obviously, if China's still looking good, then you would probably put more weightage towards that.
But let's talk about India now, Andrew. How do you feel going into the earnings season? Very quickly and swiftly, the markets have given up nearly 4% from a record high that was made only last week. Do you feel like there's some bottom fishing, value buying for an investor? Now could be a good time to start adding incremental capital?
I remember when we last spoke and we were, the markets were at highs, and all the negatives that we could talk about then just didn't matter. And coming into earnings season, if you remember, I said that I wasn't very excited. I'm still not excited. I think it's going to be a weak earnings season. And unless we start to see the government capex and private capex pick up very quickly, orders given, then that kind of multiplier effect, that kind of impact for companies is probably not going to be felt as much in the second half. So you're not going to get that earnings increase. So therefore, valuations were always a tough one when we were hitting highs, and we've just became overbought. So a combination of many factors, including China, has probably just taken that a bit of froth off the market, which is no bad thing. So I'm not overly negative. I'm just kind of cautious because I think the earnings season will not be great.
Earnings season will not be great is something that people are saying, but what are the pockets that are bothering you the most, Andrew? Is it on the consumption side? I mean, the initial sort of numbers coming in from Avenue, same sales store growth numbers, for example, or from auto sales in September, that's raising some question marks. On the other side, you have a whole host of BFSI updates, which are not that great either, at least at first glance. So which are the sections which are worrying you the most when it comes to Q2 numbers?
I think you just mentioned them all, Tamana. I think those are the areas.
Two of them. Those are the two worst.
Well, BFSI is quite a large sector across the board. Autos, obviously. So I think the only kind of positive I can see from the earnings season is probably the kind of more commodity based companies. But otherwise, I think it's going to be a weak earnings season. Narrative around the future is going to be key. So there's going to be pockets of companies that do well. I'm not convinced the IT sector is finally there at the bottom yet, and it's had a good run. I'd probably do more of my bottom fishing around the banking, where we're probably getting closer to the bottom there, and valuations are more compelling than IT.
Right. Andrew, well, we've talked about business updates and sectors that you're tracking fairly closely. What happens to the way crude is currently moving? With rising geopolitical stress, it seems like there could be some more gains on crude prices. How do you think that's going to, what is it going to do for our macros, A, and B, in terms of crude sensitives? Are those sectors or pockets of the market best avoided for the foreseeable future?
Yeah, I mean, from a trading viewpoint, obviously, they become, some of those sectors where the inputs are with oil, they become, favored shorts, right? But you're really playing a geopolitical kind of, trade there. And I'm not saying that that will go away from us. We'll have to wait and see what Israel does over the next few weeks, next few days, actually. So the weekend is probably important in terms of any development there. But it's really a trade, I think, to do that, because if anything kind of breaks in terms of any kind of ceasefire or anything like that, then the oil price will come tumbling down very quickly. So I think it's something that you trade rather than it's a long-term view that the oil price will remain where it is or a lot higher for a lot longer. Because if it does, then obviously it has a global impact in terms of global growth, then interest rates and so forth and so on. So it's a bigger play, not just an India play. But I think India is obviously buying its oil from elsewhere, so hopefully it will keep the inflation figures down. But what it does do is probably edge the RBI to be more cautious going into its monetary policy meeting next week, and therefore any hopes of that kind of maybe small pivot in interest rates coming lower after the Federal Reserve has probably been tabled or put aside for the moment, and therefore December becomes the main play.
Andrew, in a lot of our previous conversations, you've talked about coming in when there's a bit of correction in the market. Has the bit of correction now taken place? More to come? Are you seeing levels comfortable where you want to start buying again?
No, I think the one which I'm looking at a little bit more closely is the banking sector. Again, it had a good strong run on some of the factors we talked about before, Tamara, in terms of global interest rates falling and the likelihood of interest rates falling here. It's coming to a point now where it's getting to that oversold territory. So it's becoming, as I said before, it's becoming in terms of, I think the earnings are starting to NIMs are starting to bottom out, and therefore it's a place where I'd look to bottom fish a little bit more, because the valuations are more compelling than other sectors.
Given that everything is now going to be more homebound and homeward looking, especially with everything that's happening globally, Andrew, I know you like hospitality and we've talked about this extensively. Do you still feel like this is a space you want to be going long on? Any of the new sectors that you've identified that could become potential long trades? So maybe mass consumption, maybe luxury spending, anything that stands out there for you?
Yeah, well, I think, given the markets recently, I think probably everyone would want to go on a holiday. So I think hospitality remains, something which I would continue to favour over the next 2 years. Premiumization in beverages doesn't go away. And if anything, the power sector, I think, is ready for, to see quite a lot of contracts being awarded. So I think the power sector is something which I think is going to be a theme which will start to play out over the next 6 to 9 months gradually as more orders are given, and as we see, that demand is obviously very high and will continue to be high. So look at wind power, look at renewable power, and I think that's where you're going to make some good money over the next 1 to 2 years.
Thank you so much, Andrew Holland there.